Thanks, everyone. Thanks, Selftrade, for giving us this opportunity to present some of the new products we're working on, and hopefully will roll out in the next few months. I'll explain a little bit about the background of InTune Investor, but throughout the presentation, we are effectively working on behalf of the retail investor in all aspects. So when I say us, it's basically we look at the world through the eyes of the retail investor and how we can make the proposition or how we can make the outcome for them better than it currently is. We love feedback any which way, either to improve the products that we're rolling out or anything that we do. So please feel free to drop us a line if you have a moment or a chance. You will see on these slides this strange text message here at the bottom. This is a new video delivery trial that we are experimenting with. It is free, so if you have a moment at some point later today, just text ETF to 60666. There's a video that will come straight back to you, courtesy of the London Stock Exchange and one of the ETF industry's leading consultants, Deborah Furr, who has put together a 15-minute video or so, again, setting out all the basics for ETFs, which is also quite useful. If this delivery system works, then we've got plans to expand it and hopefully send out more educational material. So just before I start, a little bit about who we are. So my background was in asset management in the States for 25 years. I moved back to the UK and was somewhat shocked at the state of the provision of financial services. So together with 2 or 3 or 4 colleagues, we formed InTune Investor in 2012 and set about trying to transform to the best that we could the provision of financial services. We recognized there were 3 things we needed in order to bring about that change. The first being absolute return funds, which really do what they say on the can, which is deliver to the investor a steady, predictable, absolute return ahead of inflation, ahead of the taxes, so that we can all plan and have peace of mind and some security rather than exposure to the market ups and downs. The next thing we recognized that we needed a platform on which to deliver these tools, designed for mobility, designed for phones and for tablets, and we're working on that. And on that tablet, we needed some cutting-edge data visualization, entertaining tools which made researching and handling and dealing with your finances fun and entertaining and worthwhile again. So as a company, we're sort of pushing ahead in a variety of areas. It may look like a bit of a mess this afternoon, but believe me, we will eventually get there. Our strapline is to help anyone invest successfully, and basically that's what we try and do in everything that we do. So onto the sort of presentation. I thought it might just be helpful to, at least for me, to summarize where I think we are at the moment. And stuck in mud is probably an apt description, in that the majority of us are still invested in overly expensive mutual funds, which are really not doing what we want because they're exposing us to the ups and downs of the twos and fro's of market exposure. And that's not necessarily where we want to be when we want to forecast our pension and predict our future income streams. We really need something which is much more stable and resolute. At the moment, we really don't have that. Again, as background, just to frame the discussion, where is the UK assets presently? What is the size of the UK asset management business, let's say? So on this, it may be difficult to read, so I'll just go around. The biggest chunk here, we've got 5 trillion under management by UK asset managers in the UK, approximately as we sit here today, of which 2 billion is money that we manage on behalf of overseas investors. So for the moment, for this discussion, we can somewhat discount that. Here in the UK, the next largest chunk is 1.7 trillion in pension funds and pension products. The insurance industry account for the next half a trillion. But what's really relevant, I think, to us here in the room today is the 800 billion, which we have collectively invested in, let's call them OICs and trusts. I'm just using that a generic term for funds. Now, within all of that, and I can't allocate it by sector, but there is 225 billion currently invested in ETFs listed on the London Stock Exchange. So most of that money is invested by the institutions, so most of that is coming out of this sector here. There's still, although I don't know the exact number, not that much that's come yet from the retail marketplace. So why has retail not really taken off? Again, this may be slightly difficult to read. I think we all agree one of the principal reasons probably has been the commission trail on selling mutual funds from IFAs. That's set to end and end for good as of April 2016. So that should then incentivize IFAs to take a much closer look at the world of ETFs and to start to recommend them to their clients and start to build portfolios. I think that will be a major milestone. But there are some other background trends. The defined contribution pension plan revolution effectively is estimated to encourage another 9 million individual self-directed savers and investors over the next 4 or 5 years. So that will be good. And as we can see from this BlackRock Fidelity survey conducted in March, IFAs are expecting to up their allocation to or interest in ETFs. Now, as I was researching for the presentation, I came across another annual survey from the Investment Association, formerly the Investment Management Association, or IMA, in which they noted that the UK asset management industry contributes 6 billion to UK exports. And they obviously were proud of this number, as the survey most likely directed at policymakers. But it got me thinking, $6 billion is a very large number. So I went onto the web and tried to figure out where that positioned the UK asset management industry in terms of UK's overall total exports. And if you, cars are our largest export. We export about 35 billion, but we also import about 35 billion. So if we net those off to zero, and we net off crude and energy products, which are similarly basically netting off to zero, our largest single export, which is the net revenue earner, is aircraft component parts, which is of around about $10 billion or so, which leaves, by my calculation, asset management is potentially our second largest export earner in the country, followed just closely on the heels by hard liquor exports. But so that got me thinking also, if this is our second largest net export revenue earner, excuse me, what is it costing us, the retail investor? What are we paying to the asset management industry for them to manage our mutual funds and our money? So coming back to that 800 billion number in Oyster trusts, and assuming, and this is just an assumption, that on average we're paying away 1.5% in annual fees, both to the platforms itself and also to the fund managers. As you can see, that's a pretty big number. We're paying $12.5 billion a year to the asset management industry to manage our money. And then I thought, well, that's just 1 year. What happens if we extrapolate that out a little bit and look at the sort of the conditions of the average investor who perhaps has their money locked up for 20 years? What would be the total impact in that instance? So if we assume we start with our 800 billion, it grows at 5% a year for the next 20 years, we as collectively, as UK investors, will have paid the asset management industry £553 billion to manage our money. That's, by my calculations, approximately half of the UK's GNP as we sit here today. So it's a simply monstrous number. So that got me thinking, what is the impact of these fees on our individual accounts? So we did a little bit more research. Bear with me here a little bit. So we've got two individuals. Let's call them John and let's call them Sarah. And John comes along and puts £10,000 into an OIC unit trust sitting on a platform somewhere near Bristol, maybe. He has invested in what are already relatively low cost, what they call clean funds. So there's no trail commission in here, 75 basis points or 0.75%, which is probably way below what most of us are currently still paying, for a total annual charge of 1.2%. I think most of us here in the room would agree, well, that's not too bad. Sarah, on the other hand, takes her £10,000 and invests it in an ETF at Selftrade, and she's paying 20 basis points a year, and that's pretty much it, apart from the commission in, the commission out, and perhaps a bit off the spread. But for the moment, because they're just one-off charges, I think we could ignore those for the sake of this experiment. So her annual charge is 0.2%. There is a point to all of this that I'm coming to. And they leave it for 20 years. In 20 years' time, John and Sarah come back to have a look at what they've got for their retirement. John opens up his envelope. He's really rather happy. He's made over 100% on his return, on his initial investment, and he's delighted with that. He turns to Sarah and says, well, how much have you got? Sarah opens her envelope. She's got £25,000, but more importantly, she's made 154% or 50% more money than John. But some of the really staggering numbers here are, whilst Sarah's only paid away 6% of her profit over this 20-year time period, John has paid, getting on to half of all the money he's earned, he's paid away in fees. So I hope somehow in all of this, the point's getting home, fees are a real problem. And if there's one sort of takeaway, I think, from today and perhaps from today's presentation, that we as individual investors, retail investors can do, is really minimize our fees, because they are compounding and they are highly detrimental to the ultimate performance of your portfolio or your investment returns. So we've established that fees are a big problem. We realize now we've got to go to something much more low cost. We know that ETFs are now established and mature. There are, as I mentioned earlier, 225 billion invested, and that's just on the London Stock Exchange. Of course, they trade on other exchanges around Europe. So why have the retail floodgates not opened further? I know throughout today's sessions we've touched on a variety of these problems, but I'll try and take a slightly different tack. I think the biggest issue, and I know Mark alluded to this in his opening address this morning, is probably one of confusion. How, if £10,000 were to arrive in your lap, how would you find the ETFs, put together a portfolio, which issuers? There's so much confusion currently that still surround this industry, and it's not just the naming convention, and I'll come to this in a moment. There are well over a dozen individual issuing companies. Many of them have competing products. The comparison between these competing products is difficult to establish. They all have different expense ratios, different assets under management. And for anyone who's ever tried to research ETFs, going to the individual issuer websites and trying to extract from them exactly what it is you're perhaps looking for is enormously time-consuming and difficult. And I bet most of us give up after the last 4 or 5 minutes. So we, recognizing this was an issue, developed a tool to help this comparison. And if I could ask the guys at the back to switch us over. It's called ETF Look. It's available. It's free of charge. It's at www.etflook.com is the website. It was built in association with FTSE and the London Stock Exchange in order to make searching and researching ETFs that much easier. Just very briefly, and I won't bother you with this, there's a tutorial section which tells you how to use the website. There's a learning section. This includes about 15 different videos that the London Stock Exchange and FTSE put together, all from extremely knowledgeable people. They all last 5, 10, 15 minutes. And I would suggest taking a quick look at those. But those are just the landing screens. So this is the tool itself. It may be slightly difficult to see, particularly back in the back. But the idea was we wanted to visualize on one screen all the 1,100 ETFs listed on the LSE. And that is what this does. The resolution is not so good, so I apologize for that, but you'll get the gist, I'm sure. Each ETF is represented by a little bubble. The size of that bubble represents its assets under management, and the color of the bubble represents its primary asset class. So we've got alternatives, fixed income, commodities, international equities, properties, currencies, money markets is all sort of there. So what would we like to do? There's a number of things we could do with this tool quite straight away. We may only be interested, let's say, in an equity ETF. So by searching through by asset class, we can now find all the UK equities. They're all listed here. We can hover over any one of the bubbles. We can see, in this case, this is the iShares UK Equity, FTSE UK Large Cap. It's got its assets under management, 3 billion, total expense ratio, 7 basis points, and its 1 year return, which unfortunately is down, but that happens. We double click that bubble, we go to this detail screen. Again, apologies for the small script, but it's much easier on your laptop or website, or laptop or tablet. And immediately we can see the detail that underpins that, including for some of the gentlemen here that have been discussing earlier, we list the bid offer return down here, the bid offer spread, up here, the total expense ratio, and so on. We can make that a favorite, which is equivalent to adding to our portfolio. We might want to, for example, look just for Deutsche Bank products. Here's all the Deutsche Bank products. We might want to look at bid offer spread, because I know that was an issue that came up earlier, and I'll just make that universal. So we can see any ETF that we select, we can see what that normally is, which is important for some people. And also important is this total expense ratio. So here, all the ETFs listed on the LSE are all designated by bid offer spread. So if you wanted to just perhaps look at, well, let's look for a FTSE tracker. Maybe we're interested in buying a low-cost FTSE tracker. Here we go, the iShares UK Equity, FTSE UK Large Cap, total expense, that's the same one again, and bingo. So I hope you sort of get the idea. There's lots of functionality here. Currency, if we just wanted sterling ETFs, we can have sterling ETFs, the favorites, etc., etc. You can search for an ETF. You can enter it. If you know its exchange sticker number, just type it in here, and there we go. So this is slightly in beta. We hope to continue to develop it, and hopefully people will find this as a useful tool to help them, at least in their initial research, of finding out which ETFs potentially they would like to research further. So if we could go back to the main screen. I just want to touch on another theme which I know has been expressed today regarding the benefit of ETFs. We've discussed the importance of cost. We like the fact that they're tradable throughout the day and at any time. But what we find at InTune, one of the most attractive features is that they represent this sort of pool of diversity. And why is that important? Because most of us, with our normal allocation in our pension plans and our investment trusts, still have this predominant sort of overweight to, or some semblance of a 60% equity allocation, 40% bond allocation. Effectively, we have all our eggs in one basket. But there's a problem with that. There's a couple of problems with that, as I'm sure most of you are aware. And I recently took, actually, my wife's pension plan and ran it through our system. And although she's got about 10 different mutual funds, all of the names that you'd be familiar with, the reality is they're all effectively the same product. They may have a different brand name, but they're all buying the same UK companies, et cetera, et cetera. And what was worse is that the collective portfolio that had been put together by an IFA was actually 90% correlated to the FTSE 100, which just happens to be one of the most risky instruments, a great instrument, but a highly volatile and highly risky instrument. And that just doesn't seem right to me, that one in saving for pension should have such a high degree of exposure. And as we all know, correlations within the market have tightened over the last 4 or 5 years, particularly since 07 and 08 in this what's called risk on, risk off. No one quite knows why. Everything's become so highly correlated, but it could be globalization, it could be algorithmic trading. The jury is still out, but effectively, as we see every day, Asia's down, London goes down, New York will probably go down, and so this vicious cycle continues. And it's almost impossible to find true diversification within the equity asset class anymore. So what can we do about it? We can turn to ETFs. And I know you can't read the screen, but that actually is not necessary, and is to show my point that within the universe of ETFs, there's virtually everything that you can possibly think of. We have the whole equity sector, as you would expect, large cap, mid cap, small cap, all the things that you're traditionally familiar with. We've got mining, we've got income, we've got infrastructure, so that's all there. And fixed income, we've got every fixed income ETF that you could possibly hope for. Governments, corporates, all by duration, local government. We've got commodities, broad commodities, single commodities, broad commodities excluding energy. We've got currencies, either individual currencies, baskets of currencies, and most of these now have some short and or leveraged version, so that you can be 2 or 3 or even, I think now 5 times leveraged against particular assets if you so wish. I don't recommend it necessarily, but it's possible, and also short. You can sort by geography, by region, by country, by area. We've got income products or capital accumulation products, and finally, we can replicate private equity, hedge fund strategy. So within this universe, it's a really broad palette from which one can choose and select and build portfolios. So that's the second part of what we do at InTune Investor, is to generate a diverse portfolio for our absolute return funds. And we do that by taking in all the data from all of the 1,100 ETFs every night and running all the correlations, 1,100 times 1,100. And it's actually much bigger than that. I've forgotten the calculation. But it's millions and millions of calculations overnight. And then we separate all the ETFs out into what we call buckets of diversity. So each bucket has got nothing to do with another bucket. And we typically end up with 15 or 20 buckets, all of which are completely different in terms of their return profiles than the other one. And then we can select from those buckets to build a fully diversified portfolio. And just illustrative, this is the result of our backtested, admittedly, performance going back to 2010, which is when ETFs effectively became available here in the UK, as measured against a generic world MSCI World Equity Index. Now, the last 10 years have been, the last 5 years have been pretty good for equities, so the MSCI has done relatively well until perhaps just recently. So just have a quick look and see how we did with our diverse portfolio during the months of July and August. This is July and August, and you can see where the blue line, we were up 5% in August. Equity markets were down 9 or 10%. And that's all down effectively to the benefits of diversification and not having your eggs all in one basket, which ETFs allow. Anyone from the FCA here? FCA, this is not a solicitation to sell. So this is a product we're marketing at high net worth individuals, but we hope to have a UCITS version out in early 2016. So just moving on a little bit, we've touched on the confusing names issue. I just, for fun, took from our database this morning, just by random, and believe me, this was purely random, 2 names which get delivered to us from a leading data provider every day. I mean, it's just gibberish. How can anyone be expected to understand what that might mean? So we have built out our own naming classification, which hopefully we'll adopt with Selftrade so that these names will be finally explicable and clear and enable you to make a much more educated selection. There's another issue which we're solving, which is that currently, whilst funds have a style classification that you're probably familiar with, I think the Investment Association promulgates 30 different styles into which all the 5,000 or so mutual funds all fit. There isn't currently the same style classification for ETFs. So if, for example, you wanted to switch a fund to something similar in the ETF world, it's hard today to know where those ETFs sort of correspond in terms of style. So we're working on that and hope to have that finished in the next month or so. Finally, the key to a part of getting more retail education and interest and attention into the world of ETFs is to get the IFAs more interested. As I mentioned, as we know, trail commissions finally end in April 2016. And then, at least from where I sit, if I was an IFA, why would I not want to call up my client and say, I can save you £5,000-10,000 if you switch from mutual fund to ETF? That's good, solid advice. That's saving my client money. And the client will happily, I'm sure, send a check and pay for that advice. So I think that is all good news with regard to ETF take-up. There is still one last issue, and that's really the sort of final product that I want to present you tonight, get your feedback on. So I'm going to make the assumption that most of us sitting here in the room today probably have some mutual funds in our portfolio, and having listened to me gibber on for the last 15 minutes, will probably like to find a way to at least explore or research switching those mutual funds into a lower cost ETF and to see what benefits might accrue. So we have developed a product that is currently codenamed the Hound, but probably may well end up with another name. We're working with Selftrade exclusively to deliver this product/app onto the Selftrade site so that anyone free of charge can go onto the Selftrade site, enter in their mutual funds, and find a matching ETF, calculate the savings, etc., etc. And I'll give you a few screenshots of how this works. So at the top of the box, and unfortunately these are just screenshots today, there is a live demo version, but in a few weeks' time we'll have a much more up-to-date, and we'll launch a beta website. So without picking on Jupiter at all, who do great mutual funds, one can type into the search box, as one would imagine, and as you start typing, it starts finding your particular product. So here we've typed in Jupiter European. There's another sort of box or screenshots where you set your preferences. I've got a £10,000 investment in Jupiter European. I plan to hold it for 10 years. We'll assume we're going to get 5% return. I don't mind matching it to any style, or I want to match it to just European ETFs. So these will be drop-down boxes that you can select. I want to stay in sterling, or I don't mind which currency it is. All of these are a quick sort of user interface. And lo and behold, because we are pulling in all the correlations between 5,000 mutual funds, 1,100 ETFs every night, and doing all the millions of calculations that are necessary, we're able to identify the closest matching ETF by historic return profiles that matches the mutual fund that you currently have. Similarly here, then we calculate that if you were to maintain switch your investment into this iShares product, similar parameters, 10,000, 10 years, 5%, your total return at the end of the day would be £6,000 odd pounds, and you would have paid away £113 in fees.
Okay, I think your time's up, I'm afraid.
I've nearly finished. One more second. This is the last screenshot, effectively. And then we illustrate the total amount that you would have saved if you made that switch. So we can skip that. So in summary, thank you very much. We're very optimistic with regard to ETF assets and usage continuing to grow. And
please join us on the Selftrade stand at 4:30 for a drink, and we'll show you a little bit more about this, and if you've got any questions specifically, we'd be delighted to answer them.